Presentation on intercorporate dividends presented by Sushmita, MCom Final, MPM Government First Grade College, Karkala. What are intercorporate dividends? When a company receives dividend by virtue of its shareholding in another company, such dividends are known as intercorporate dividends. Such dividends are exempt from tax when they are received from a domestic company if received prior to the 1st of April 2020. A company receives dividend from other company, it is called intercorporate dividend. In other words, we can say that intercorporate dividends are those dividends received by a corporation from investment in common and preferred shares held in other corporations. The dividends which are received from the domestic company are exempt from tax if they are received before 1st April 2020. Scope of Section 80M. This section applies to the domestic companies that have declared dividend and are also in receipt of the dividend from another domestic company. A deduction is allowed with respect of the dividend received as long as the same is distributed as dividend 1 month prior to the due date of filing returns. Section 80M explains about the or applies to the domestic companies which are declared and also receive dividend from other domestic company. A domestic company will be allowed for exemption of dividend from other domestic company only when it has distributed its dividend 1 month before filing the tax returns. Period covered under this section. This section is applicable in respect of dividend distributed on or after the 1st of April 2020 assessment year 2021-22 onwards. The 80M is applicable to the companies in respect of dividend distributed or declared on or after 1st April 2020, that is the assessment year 2021-22 onwards. Law before Section 80M. Section 80M did exist in a different form in the earlier income tax law but was scrapped when the concept of dividend distribution tax was brought into the income tax law via the Finance Act 2003. DDT was introduced to make it easier to collect the tax at a single point. The tax on dividend was levied at the time of distribution itself and made exempt in the hands of shareholders. Dividend distribution tax is a tax levied on dividends distributed by companies out of their profits among their shareholders. The DDT is taxable at source and is deducted at the time of the distribution. According to the law, DDT is levied at the hand of the firm and the shareholders. The dividend distribution tax was brought into income tax law through Finance Act 2003, which scrapped the Section 80M, which existed in different form in the earlier income tax law. The DDT was introduced for more efficient dividend tax collection from companies rather than shareholders. DDT is exempt in the hands of the shareholders. Further, in respect of dividend distribution tax, liability holding company received a deduction to the extent of dividends received from subsidiary companies, since the subsidiary companies already paid DDT in respect of the same dividend. Hence, double taxation of the dividend income was avoided only in case of holding subsidiary companies. Here, in the concept of dividend distribution tax liability, the holding companies are free of paying tax and get deductions as the subsidiary company already pays the DDT on the dividend declared. There the double taxable taxation of dividend is not applicable only in the case of holding and subsidiary companies. Thank you.